So when we think about depreciation, we want to think of it as, and this is an important definition, right? The process of allocating the cost of a plant asset to expense in the accounting periods benefiting from its use, all right? And so that is the purpose of depreciation. I like to think of it as a systematic approach of spreading the acquisition cost of assets over its estimated useful life. All right. So when assets are purchased, they're capitalized, which means they're put in an asset account. All right. And over time, we're going to shift chunks of that to the income statement, right? And that's depreciation. Anytime we're given a depreciation problem, you're going to be given three factors, all right? What it cost, right? In some cases, we may even need to compute the cost by adding purchase price and setup cost, but we'll be given some method of getting to total cost for an asset. Salvage value, right? And this may be referred to as salvage value or residual value. But it's management's estimation of what the asset will be worth, what they'll be able to sell the asset for at the end of an asset's useful life. All right, so if it's a car that the company plans to use for 10 years and then sell for $2,000, the salvage value would be $2,000. And sometimes it's called residual value. That's a synonym. All right. And useful life, also an estimate. That's how long the company expects that asset will be useful to its operations. All right. So it is worth noting that in depreciation, cost is a verifiable fact, but salvage value is management's estimate, our best guess, of what the company will be able to sell something for at the end of its useful life. All right. And then the useful life is also an estimate. The asset could last longer or it could last shorter than the estimated useful life. Okay. So we are going to be responsible for three kinds of depreciation, three methods of depreciation. The first is straight line, which is the most widely adopted and most straightforward method, and it's the most predictable as well. The next is units of production, which is an activity-based depreciation method. So, for instance, if it's a machine, then units of production would be, our depreciation expense would be driven by the units produced on that machine. Or if it's a car, the activity driver for units of production might be miles driven. All right. And then declining balance, which is what we call an accelerated depreciation method. All right. It's accelerated because you get your biggest depreciation expense in the early years of an asset's useful life, and then they decline as time progresses. All right. So here's the asset that we have. Cost $10,000. Management estimates it's going to be worth $1,000 at the end of its useful life, which is 5 years, or 36,000 shoes outputted. All right. Now, the other thing to remember is when you're given cost and salvage value, you only depreciate, you only depreciate the difference between those two numbers. In other words, you don't want to depreciate below the salvage value. So straight line method is really very formula based. All right, cost less salvage value for this problem is 10,000 less the 1,000 divided by 5, which is the estimated useful life, giving you $1,800 of depreciation a year. All right. And here we have the journal entry, and we saw this back in chapter 3. This is your period end adjusting entry. I mentioned that we would get into how we get to the depreciation numbers back in that chapter. So this is that. The debit for depreciation always goes to depreciation expense. All right. The credit goes to an accumulated depreciation account, which is a contra asset account, and it functions not unlike the allowance for doubtful accounts. It's a asset account that has a normal credit balance, and for balance sheet purposes, accumulated depreciation is subtracted from the asset category to which it's related. So for this example, you'd have machinery as an asset, and then you'd have accumulated depreciation machinery right below it, subtracted out. All right, and we'll take a closer look at that in class. So the reason why straight line is the most commonly used depreciation method is when you get the same depreciation expense for every year of an asset's useful life. So you remember we were depreciating this machine over 5 years, right? And so in 2017, depreciation expense related to this machine, 1,800. 2018, same. 2019, same, and so on, right? So that's ideal for financial managers to know what the depreciation expense charge is going to be. All right. Book value. So book value is a term that we should define. So I mentioned just a slide ago that book value is an asset's cost, or the amount in the asset account, less accumulated depreciation. So your book value is the net balance sheet effect. So for this asset, it was acquired in 2016, no depreciation, so the book value was $10,000. That's what it cost. $1,800 of depreciation in 2017, leaving book value of $8,200. And so the book value of this asset is going to decline $1,800 each month until you get to the end of its useful life, 5 years in the case, as is the case here. And at the end of an asset's useful life, its book value will always be equal to its salvage or residual value. So you remember that was $1,000. That's what we're seeing here. Here's a depreciation table. We'll be creating some depreciation tables. The ones for straight line are relatively easy. So you have a column for your depreciable cost. I believe this asset was acquired at the end of the year, which is why there's no depreciation in 2016. In 2017, depreciable cost is, of course, the purchase price less the salvage value. All right. Depreciation rate was just 1 divided by the useful life. All right, so 20% per year. And this is the same information we just saw. So there's your $1,800 per year, and then the accumulated depreciation increasing each year, and the book value decreasing each year. All right.